There are a number of pros and cons associated with taking a 401k loan. There are definitely life events where taking a 401k loan makes sense, but there's other situations where it should be completely avoided. Today, I'm going to be sharing with you some of those real life scenarios we've learned working with plan participants in 401k plans. But before we do that, we should really get into how a 401k loan works. You should understand how much you are allowed to borrow, the duration of the loans, what is the interest that is charged, how are loans paid back to your 401k account, the penalties and taxes on the loan if the loan balance were to default since you left employment or you resign, and how these loans could potentially impact your retirement. People are often shocked to hear a financial planner say, sometimes taking a 401k loan makes sense. You would think a financial planner would say, under no means do you ever touch your retirement accounts for anything. But the reality is sometimes life presents us with challenges and opportunities that require you to have access to capital. Some of those situations that we've seen are people need access to capital to start a business. They need to resolve a short-term cash crunch. They need money for a down payment on a house. They want to pay off high interest rate credit cards, or there's been an unexpected health expense or financial emergency. I will provide you with real life scenarios of each of those examples later on, but first let's talk about how these 401k loans work. First, know that even though you may have access to a 401k plan, not all 401k plans allow loans. It's a voluntary feature that your employer has to allow plan participants to have access to. So first you have to check and see if they're available. If they're available, let's talk about how these work. How much can you borrow in the form of a 401k loan? The limit is the lesser of 50% of your vested balance or $50,000. So if you have, let's say, a $20,000 balance in the 401k plan, your max loan amount is $10,000. Now you can take less, but that's the max amount. That $50,000 limit applies to anyone who has a vested balance over 100 grand, because you could have a balance of 500,000 in the 401k plan and you're still limited to that $50,000 max 401k loan. Do you have to pay interest on a 401k loan? The answer is both yes and no. There's an interest rate built into your amortization schedule, so interest is paid back as part of your payments, but the interest is deposited into your own 401k account. So you're paying yourself the interest. So for all intents and purposes, for you, it's an interest-free loan. The interest rate that's charged by most platforms is usually the prime rate plus 1. How long can you take the loan for? When you apply for a loan, you have to choose a duration between 1 and 5 years, 5 years being the max duration for these 401k loans, unless your plan allows an exception for purchases of a primary residence. Some plans will say, if you're using this loan to purchase your primary residence, you can stretch out this 401k loan over the duration of your mortgage, which could be 15, 20, or 30 years. But I always say caution, because if you leave the employer before that loan is paid in full, you could be looking at a loan default, which we will cover later on. How do you make payments on the 401k loan? So normally it's a payroll deduction. So they hand you a check for the loan from your 401k plan, and then starting the next pay period, you should see deductions based on your amortization schedule, and then that goes back into your 401k account until the loan has been satisfied. If you're a self-employed individual and you have one of these single K plans or 401k plans and you don't have W-2, then normally you're just issuing checks to the 401k platform in accordance with your amortization schedule. Are 401k loans a taxable event? Meaning if you take a loan, do you have to pay tax on that money you took in the form of a loan? The answer is no. They're not immediately taxable events like a distribution. If you took a distribution from the plan, you're going to have to pay Fed, state, and potentially an early withdrawal penalty. Where the nice thing about 401k loans, it doesn't trigger that tax event. Now that you have an understanding of how these 401k loans work, let's talk about some of those real life scenarios where taking a 401k loan makes sense. Now, just kind of know in all these scenarios, if you have idle cash sitting on the side that could be used for any of these purposes we're going to talk about, usually that makes more sense than taking a 401k loan, because if you're taking a 401k loan, you'll find out later on that you're missing out on compounding interest. There's some other takebacks of taking a loan where usually using your cash will make more sense. But let's talk about some of those positive reasons. The first reason is paying off high interest rate credit card debt. We will consult with plan participants that have run up credit cards. They're paying 15% plus an interest, and they're only making minimum payments, so they can never seem to get ahead. In some of those scenarios, taking a 401k loan paying off those high interest rate credit cards, and then essentially you're paying the interest to yourself. So it's an interest-free loan, but the only way this works is if you're not going to run up those credit cards again. You have to have the discipline that after you do this maneuver, not running them up, because you won't have a bailout the second time around. And also, if you're in a really tough financial situation and you're looking like you might be heading towards bankruptcy, you definitely don't want to do this maneuver, because your 401k account has ERISA creditor protection, meaning in bankruptcy, that's a protected asset. So you don't want to be pulling money out, using that money only to lose it in bankruptcy. The second reason is you experience a short-term cash crunch. So sometimes you'll be in a scenario where you have an expense coming up, the cash or income was expected to be there to pay that expense, but now that income or cash has been delayed. So you need to create a bridge between those two items. And one of the most common is when people are buying and selling a house. So some people need to sell their house to get the cash for the down payment on the new house. But if for some reason something happens, the closing gets delayed on the house they're selling, they need to come up with cash. Maybe let's say it's $30,000 to close on the house they're buying. So what they will do is they'll take a loan from the 401k for the 30 grand, close on the house they're buying, and then when the closing happens on the house they're selling, maybe 30 or 60 days later, then they have the cash to go back and just repay their 401k loan and they're square. The third reason is needing cash to start a business. We've had clients leave the corporate world and want to start their own business, and one of the greatest challenges for entrepreneurs is finding the cash in the early years to operate the business and meet their personal expenses while they're trying to get the business to cash positive. And if you don't want to go to a bank and get a loan, or if you don't want to raise like borrowed money from friends and family, one of the options might be a 401k loan, because if you had a 401k with your former employer, you can roll over that balance to a solo K or 401k with your new self-employment entity. And then once it's there, then you can take that loan to help bridge some of that cash gap. Another word of caution with this option, you're using now retirement assets that were supposed to be there to help support your retirement to fund a startup business, which can be risky. It's common for young professionals to need money for the down payment on their first house. So they've been contributing to retirement accounts like they should have been all these years, taking advantage of employer matches, and now that 401k is their largest actual personal asset. And then all of a sudden this great opportunity comes along to buy a house and not have to pay rent anymore, to start building equity, but they don't have cash for the down payment. In some scenarios, it could make sense to take a loan from your 401k so you can transition into a house. A word of caution with this option: when you take a 401k loan to purchase a house, if that 401k loan is not going to be paid in full shortly after you buy the house, now you could have two new expenses. You've got the deductions in your pay for the 401k loan, and you also have a new mortgage on the house you bought. So make sure you're doing some budgeting in advance of making this decision. Let's shift gears now. We've been talking about real life events where it may make sense to take a 401k loan. What are the situations where it doesn't make sense, or what are the drawbacks to taking a 401k loan? The first is your money is out of the market when you take a 401k loan. So if you request a $50,000 loan from your 401k, that money leaves your 401k account and you have it, and you're paying it back in slow increments. But in the interim, that money is not invested, it's not compounding returns over that time period, and it could leave you with less once you reach retirement. Let's look at a real life example of this using Steve and Sarah. So in this example, Steve and Sarah are both 30 years old, both plan to retire at age 65, both experience an 8% annualized rate of return on their 401k account, and both have 401k balances right now of $150,000. Now the difference is Steve decides to take a $50,000 loan for 5 years at age 30, but Sarah does not. My question is, how much more does Sarah have in her 401k account than Steve at age 65? The answer is $100,000. That is the difference in their balance at age 65, because Steve decided to take a 5-year loan when he was age 30. Even though he was paying himself interest, even though he was making payments back, since that money was out of the market for a certain period of time at 8% per year, a lot of people underestimate the power of that lost compounded interest. So it ended up being a very expensive loan for Steve in hindsight. The second big drawback to taking a 401k loan is a potential loan default. Now, these aren't always intentional. Sometimes there's events that can trigger these loan defaults that are out of your control, but it's severe because it could trigger taxes and penalties on the outstanding loan balance that you currently have in the plan. The most common event that triggers a loan default is you end employment with your current employer and you still have an outstanding 401k loan balance. Now remember, these 401k loan balances were being made with payroll deductions. When there's no more payroll coming from that employer, depending on the platform you're with, it might automatically default because no more loan payments can be made. Now, again, this option varies 401k provider by 401k provider. Some 401k plans allow you to keep making payments even though you've left employment, but a number of them do not. They pretty much say if you've left and you have this outstanding loan balance, at some point it's going to default, which means if you have $10,000 left on that loan and it defaults, you're going to have to pay ordinary income tax on it, Fed and state, and if you're under the age of 59 and a half, you would have to pay a 10% early withdrawal penalty. And it doesn't matter whether you were laid off, fired, or you voluntarily resigned, you could be subject to these loan default issues associated with the end of your employment with that employer. So if you think you might be making an employment shift soon, it may not be the best time to take a 401k loan without falling subject to those negative events. As soon as you request a distribution from your plan, even if you decide you want to roll over your 401k balance to an IRA or next employer plan, if that outstanding loan balance exists, usually those rollovers, even though they're non-taxable, trigger an automatic taxation and default on that outstanding loan balance, so be careful. The next common loan default situation is a plan termination. So if your employer decides to completely terminate their 401k plan, which can usually happen if there's a merger acquisition, and part of that acquisition is they got to get rid of the old 401k plan and they have to force all the balances out. If you have an outstanding loan balance, that loan could be defaulted as part of this plan termination, which doesn't seem fair because you had no control over it, but it's unfortunately just the way it works. But you will have some options. So option one is before your balance is distributed out of that terminated plan, you could elect to find the funds to pay that loan in full to avoid the default. The second is the IRS has like this safe harbor that says if you are subject to a plan termination and you have an outstanding loan, and you roll over the balance to the IRA, in the year that you make that rollover, you have until tax filing deadline plus extension to put the amount of that defaulted loan back into your IRA, and it will actually be coded as a rollover. The obvious challenge is you have to find the cash to make that rollover contribution, but it's a way to potentially avoid some of the taxes and penalties. The third most common default trigger is they forget to enter your loan payments into payroll. So they process the loan check, you get your $20,000, those loan payments are supposed to begin the next pay period. What if for some reason those deductions don't happen? Sometimes the employee won't say anything because they actually enjoy not having the deductions in their payroll, but you should say something because at the end of the day, if that loan defaults, you would be on the hook for the taxes and penalties. And it's not a great day to find out, hey, you know that $20,000 loan you took? You're now going to have to pay taxes and penalties on it because it defaulted because it was behind on payments. So not only do you see it in your paycheck, but you can see those loan payments being made via your online platform. Just double check. All right, so we talked about the drawback of losing compounded interest. We talked about the potential loan defaults. The third one is a double taxation issue associated with these loans. So most people have pre-tax money in their 401k account. When you take the loan, it doesn't trigger a tax event, but loan payments are made with after-tax dollars, not pre-tax dollars. So as you make those loan payments over the course of that, let's say 5-year amortization, you've essentially paid tax on that, let's say $20,000 loan. Then when you go to retire, you're going to have to pay tax on that money again because it got credited back to a pre-tax source. Thus the double taxation issue. So wait, if they are double taxing you on this money, in what scenario that you mentioned before would taking a 401k loan ever make sense? And let's look at this example. So let's say someone has $15,000 worth of credit card debt at a 16% interest rate and they're just making the minimum payments, which means they're paying about $2,400 in interest to that credit card company every year, which could last for multiple years. If this goes on for another 5 or 6 years, they could easily pay $10,000 in interest to that credit card company on that $15,000 balance. If instead they take a loan from their 401k plan for $15,000, pay off their credit cards, they're now paying interest to themselves. Let's assume they're in a 25% tax bracket. The tax bill on that $15,000 as they make those loan payments is roughly $3,755 spread over 5 years. So it's $3,755 in kind of that first tax paid versus paying $10,000 plus in interest because those credit cards were hanging around for 5 more years or more. I hope this was helpful. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.